Welcome everyone to your guide to homeownership. This guide is to help you guys and educate you on the biggest investment that you will make. My name is Carole Webb, your realtor licensed in DC, Maryland, and Virginia. And I want my partners to introduce themselves.
Hi, my name is Erin Johnson. I am a mortgage loan officer. I've been in the business over 22 years and I am licensed up and down the East Coast in 13 states.
And hi everyone, my name is Joey Van Daniker. I am a title officer and attorney. I've been in this industry for almost 10 years and looking forward to educating you on all aspects of the real estate purchase and sale process.
Okay, so we're going to jump right into the benefits of home ownership. So 7 reasons to own a home. Number 1 is the tax benefit and also your interest that you can earn on a home. Number 2 would be the appreciation, how that value increases. Equity, savings, predictability, freedom, and stability are all the reasons to own a home. Renting versus buying, there are so many benefits to owning a home versus renting a home. One of the top ones is equity. You cannot build equity by being in an apartment. So what is equity? Equity is the amount of money that you gain after you've purchased the property. For instance, if you purchased the property for $200,000 and you can now sell it for $300,000, you now have $100,000 in equity. Tax deductions. So with tax deductions, you can actually deduct the amount of interest that you pay on your mortgage payment. With renting a home, there is no deductions that you have regarding tax purposes. Security and stability. This is where you are planning your roots. You are no longer at the mercy of a landlord. You have full control of how you can decorate this home, as well as how many people can actually visit you, your landscaping. Then this leads us to fixed payments. So your rent payment will definitely go up, but with the mortgage, your principal and your interest will always remain the same. The process of homeownership is number 1, hire me, Carole Webb, your DMV realtor. Number 2, you want to get pre-approved with Erin Johnson. Once you're pre-approved, number 3, you will then start looking at houses. Then number 4, once you've found the home of your choice, you will actually submit an offer on a property. Once you and the seller have agreed to the terms of the contract, your contract is now considered ratified. Once your contract is ratified, then your loan will be submitted to the lender for approval. Once that is completed, we are now clear to close, and you are now going to closing and now become a homeowner. Benefits of getting pre-approved. One of them is less stress. As we go out, we want to make sure that we are actually going out and looking at homes that is within your budget. Once you actually submit an offer on a home, that seller also wants to ensure that you have obtained financing in order to secure the home that you're looking to purchase. So let's talk a little bit more in depth about the pre-approval process with Erin.
Now that Carole went over to the steps of home ownership, I'm going to go over the ABCs of financing and what that actually means. So A, we look at your assets. B, we look at your budget. C, we look at your credit. D, we look at your debt, and income makes it all happen. So what happens when you are ready to look into purchasing a house? You really want to understand, the process of what can you afford, okay? One of the things that we're going to really look at is do you have money saved? What is your budget? Are you currently paying rent now? And then how much do you think that you can afford monthly? So when we look at everything, credit is very important. The credit score is the golden key that will give you the opportunity and the different options to finance your first home. Credit scores, what we do is we pull your Experian, TransUnion, and Equifax. Each credit bureau is going to report your debt, in terms of your credit cards, your installment loans, if you have collections, if you've ever had a bankruptcy, and we'll go a little bit more into your credit. So what that does is a credit score can range from 350 to 850. And typically what we do is we will take the middle credit score. So if you have Equifax is 600, let's say TransUnion is 700, and let's say Experian is 750. So we are going to take the 700 as your middle score. So we take what credit score is actually in the middle. How is your credit score derived? It's derived based on how long you've had credit. It's also based on if you have limits of about $5,000 and let's say that you owe, $2,000 or you owe $500. The use of your credit is really going to make the determination of what your middle credit score is. So it's very important that you are maintaining a good credit history on the credit report, because we're looking at the credit cards, installment loans, student loans, and anything that's reported directly to those three bureaus. All right, so now that I told you a little bit about the three credit bureaus that we use to pull your credit, let's talk about how the credit score is derived from the three bureaus. So 35% of the credit score is driven from your payment history. 30% is the amount owed versus what your limit is. 10% is the type of credit used, and 15% is the credit history. So the credit history, even if you did everything perfectly correct as soon as you were able to obtain credit, typically your parents will most likely have a higher credit score than you because they've established credit a little bit longer. So the key to have a good credit score is maintaining on-time payment and really keeping your balances down at least 20% of the limit. This should generate a pretty good credit score. The average credit score that you will need for most programs are going to be 620. There are some that will require a 580, which is a little bit lower. However, sometimes a lower credit score will mean that you're going to pay a higher interest rate. And then if you want to use any type of down payment programs, they might have a higher credit score standard of about 640 to 660. So I know I started with the ABCs of financing and I said A, B, C, D, and then income. I went with C because credit is the most important thing. Now, let's talk about assets. So assets are your bank statements, your savings, your retirement. Why is it important for us to know about your assets? Well, when we're going through the process of home ownership, we need to really know, do you have money saved up? So yes, you will hear a lot of down payment programs and a lot of people say, oh, there's 100% financing. You don't need any money to get into this house. You should ask yourself, why is that? Because there are programs, but you really need to pay attention to what the requirements to get 100% financing and what those interest rates look for you. And then also, can you afford that monthly in your budget? So assets, we're going to look at 2 months worth of your bank statements and also retirement and any other accounts that you have. It's really important to have at least a couple $1,000s saved, even if you are using a down payment program. What if you get into the house and something happens? You really do need to have a savings plan in place for that. So when we're looking at the bank statements, we do look at deposits. If you have a business and you're doing things on the side and you're receiving cash payments, it's really hard to document that. So it's really important that the funds that you have to purchase this house have been in your account for at least 2 months, okay? So let's move on to the budget. Let's say that you're living at home and you're not paying any money whatsoever for rent. What I would suggest is for a couple of months, you put aside money that you would put towards purchasing a house. So if it's $1,500, $2,000, see what it's like to put that kind of money away, and then you're also going to build your savings. So the next thing that I talk about, which we went over credit, is debt, okay? So debt is everything that we look at on your credit report. So if you have a car payment, we look at what that minimum payment is. In some cases, if you have less than 10 months left on that car payment, then we will not count that payment. A lot of people might have, student loans that have deferred payments or they haven't paid or they're in forbearance. That does not mean we will not count that debt. So if we're looking at different types of loans, we will calculate at least 0.5% and sometimes 1% of that balance to determine what your future payment will be for that student loan. We're also looking anything that's on there that's being reported. You generally will not see like car insurance or utility bills or anything like that on there. So the debt that I'm talking about is debt that's on the credit report. Now, if you do have to pay child support, then that is something that we will consider as a debt. The way that child support is looked at, we do look at the court order, and if you're paying it, generally you pay child support in Maryland, and it will depend on the court order until the child is out of school, and that could also be college, okay? So that is something of a debt, or even if you have alimony. It's very, very important that you disclose all your financial secrets to your loan officer, because if you don't and it comes up later, it can be detrimental to your loan approval. The next thing that we're going to talk about is the income. So how does all of this play a part in, qualifying? There's all types of different kinds of income that you might receive. So the typical income is when you are getting paid and you have taxes taken out. So you'll get paid with a W-2, or sometimes you will get what's called a 1099. If you get a 1099, that means your taxes are not being taken out. So W-2, we take a look if you are hourly, and you work 40 hours a week, that means that you have benefits. And even if you take time off, you're working 40 hours a week. So we will use an average if that is the case. A lot of times we'll do a 2-year average if you're an hourly employee, unless your employer can confirm that you are working 40 hours a week, 365 days of the year, even though you're probably not going to work weekends. So that would be from a Monday to Friday schedule. So the other thing, if you're salaried, we would go right into just using your salary. If you do receive a 1099, if you do any side work like DoorDash, Uber, Lyft, or any side business, we will only use the income that is reported. So if you file your tax returns and there's a Schedule C in the tax returns, you grossed about $20,000. And then let's say after all of your deductions, which you can take on your tax returns, we do look at the adjusted income. So if you made $20,000, $30,000 gross, but after you wrote off your mileage, any of your expenses for that business, the income could be a lot lower, maybe 10, maybe 5, maybe even a negative number. So it's really important that you share upfront all of your income information with me, the tax returns, the W-2s, and the pay stubs. So that is one way that we're going to look at the income. If you are typically all of the programs, and I say even for the assets, it's like a 2-2-2 rule, right? You need 2 years worth of tax returns, you need 2 years worth of W-2s, and you need 2 most recent pay stubs that's going to cover 30 days. That will give us a very good picture of what your income is and how we can calculate what you're earning to qualify for the loan. So if you are self-employed, we definitely do need 2 years tax returns, and you need to be in business at least 2 years. So if you just started a business, we cannot use that unless you have a 2-year reported tax return for that income. If you decide that you want your budget to be a little bit higher than what it is right now, and you say, I'm going to go out and get a part-time job, we will only use your primary job. If you have multiple jobs, you have to have a 2-year history of working 2 jobs, 3 jobs. I do know there's fields like nurses and healthcare where you might be able to work at multiple locations. Keep in mind, we're going to use your full-time income. The part-time, the PRN, those incomes are not stable unless you have a 2-year history for us to average. And trust me, everything that you need to learn about homeownership is not just going to be right this second. It's going to be having a conversation with me, going over your specific needs. This is an overview so that you can ask the right questions and provide the right information. So what I want to do is just give you a little example of how you qualify for a loan. It doesn't matter what type of loan, it doesn't matter what type of program. All lenders are going to use the same calculations to determine what your monthly payment should be, okay? So what I did is I took an income of $75,000 a year. So we do use, and that's, let's say that's W-2, and even if it's Schedule C, that's fine, but we're going to use the net, okay? So $75,000 a year equates to $6,250 a month. Most loan programs are going to allow you to use 45% of your gross monthly income. So let's say, with that being said, and you had $500 a month in debt, on your credit report, you should probably qualify for a housing payment no more than $2,312. So what does that mean for you? That means, what is the price range that you should be looking in? And I always say to clients, it's very important to know your payment, not your price, because what we don't know in the payment of a house is if you're looking at a townhouse, if you're looking at a condo, are there homeowners association fees, are there condo fees, because all of that is going to impact your monthly payment. So let's say $2,312 is your monthly budget. That could put you in a price range between $315 to $325. But again, in your housing payment, and that I will go over, it will depend on what the property tax is, so and the homeowner's insurance for that house. So we'll go through what that means in just a few minutes. So the next thing is, we just went through the ABCs of how you're going to qualify. Now we have to take this scenario and we have to find the type of loan and the type of program. Then you could go back to Carole, and then she could start looking for the right house for you that fits your budget and what you qualify for. So we did talk about qualification. So what is the difference between qualification and pre-approval? So qualification is when you say, my income is $75,000, Aaron, my credit score is 650, and my debt is $500 a month. That is you telling me what your information is. I haven't pulled a credit report. I haven't done anything. So your qualification is really you verbally telling me what your scenario is. Now, a pre-approval means now we have to pull your credit. You have to provide your W-2s. You have to provide your bank statements, and I have to verify your income. Okay, so that is getting to the point of getting pre-approved. So once we've done all of that, then we say, okay, so what type of loan am I going to get, Aaron? Because I've done this. So what types of loans are there? Okay, that's what we're going to go over next. There's an FHA loan, a conventional, and a VA, and there's some other ones that I'll talk about too. So a lot of people think FHA stands for first-time home buyer. It does not. It stands for Federal Housing Administration. This loan is very unique. It is backed by the government, but it does not mean that you have to be a first-time home buyer. So the benefit of this loan is it was created where all people equal. If you have a 620 or a 700, you're going to get the same type of loan criteria in that type of loan. And I'll talk about that. And then the conventional loan is something where you really should have a 680, 700 credit score so you could get the best rate, so you could get the best monthly payment. But that does not mean FHA is not the best loan, because for a lot of people, it is the best loan the first time they purchase a house. The next type of loan is a VA loan. So the veterans loan is a loan that is available for people who have served the military and they've qualified for a VA loan. And that is probably one of the best loans out there for most people that are veterans. So if you are a veteran, you serve the military, and you have this option, there should be no reason why you shouldn't be owning a home. There's also another type of loan is called the rural housing type of loan, which is also 100% financing, but it's in very different areas in the states. It has to be in a rural area, and it has different criteria, but it's also a great loan option. So with an FHA loan, and all of this can be a little bit confusing, but with the FHA loan, it typically requires a 3.5% down payment. Okay, it does not have any income limitations. You can make, as little as low as you need to on that loan, but the benefit is you only have to put 3.5% of the purchase price, sales price for that loan. The conventional loan has a 3% down payment option for first-time home buyers, and it also has a 3% down option if you are not a first-time home buyer. So let's talk about, what does first-time home buyer mean? First-time home buyer means that you have not owned a house typically in the last 3 years, okay? If you have owned a house or if you own land anywhere, if your name is on the deed or title of your grandmother's, your parents' house, you are not a first-time home buyer, unfortunately, just if your name was added on a deed. So it's very important to make sure you have no ownership of any property before we start exploring these different loan options, because your qualification could change. So with an FHA loan, it does have what's called mortgage insurance. It's a fixed payment each month, and it has an upfront mortgage insurance that is rolled into the loan. This is going to be paid on this loan until you actually refinance out of this loan, unless you happen to put down 10%. The other one, the conventional loan, also comes with mortgage insurance. And let me stop and tell you what is mortgage insurance, because people do not understand why they pay it. So way back when, statistically, if you did not put down 20%, you were considered a risk to banks to lend you money. And so what they did is they created this thing called mortgage insurance for lenders to pull from. So if you are a homeowner and you go into a house and you put 3.5% or the minimum down payment, if things get tough, you might let that house go, right? So the mortgage companies like Fannie Mae, Freddie, who secures conventional loans, and FHA, the government, said, hey, we're going to create this pool called mortgage insurance. So if we have to foreclose on a property, we can go and pull money from this mortgage insurance fund so that we can resell the properties. So it is something that you pay if you don't put down 20%, and it does not benefit you, it benefits the lender. However, it allows you to get yourself into the home, right? So once your house gains equity, rates come down, then maybe you can refinance and not have mortgage insurance. But do not think that you need 20% down to get into a house, because there are ways that you can even avoid paying the mortgage insurance if you don't have 20% down. But that's a conversation that you and I will have together. The VA loan is very unique because it's a loan that you do not have to put any money down. You do have what's called a VA funding fee with that loan, which is going to depend on your status in the military, or, if you've retired, what your eligibility is. The big thing about the VA loan is they do not have monthly mortgage insurance. And then that rural housing loan that I was telling you about, that loan is in very specific rural areas. And that loan also it's 100% financing, but it has very reduced mortgage insurance. So there are a lot of different loan programs that that you might qualify for. And these are the discussions that we will have in depth with you to determine what is the best fit for your needs and for your budget. So when we go into the next steps about looking into different down payment programs, that is also going to depend on where you're looking, what your income is. A lot of those programs are going to have income restrictions. In the different states, they have an 80% median income requirement that you cannot make over that. Some of them have 120%. So those are things that we'll uncover together. Now, if you don't have your down payment and you don't have all of that saved right now, do not be discouraged, because we can look into the down payment programs. If you have the ability to get a gift from your, family member, we'll discuss how that can be documented. And these are all the things that we would farther discuss with you. One of the things that, I would say that I like to do with my clients is Zoom calls, because I know we're all very busy, and getting in person these days are very hard. So what I generally like to do is we have a conversation, we talk about your budget, and then, we talk about looking at your credit, and then I share my screen and we go live right then and there, and you'll see exactly what you need to do. So I look forward to meeting you in person through Zoom and going through the process. I'm going to pass it back to Carole Webb, your local real estate agent, who will walk you through the process after I've pre-approved you.
Now that you're pre-approved, it is time for us to start looking at homes. And I will know all of the amenities that you're looking for, the neighborhoods, schools, and those are the homes that we'll be focused on. So now we are ready to submit an offer on a home. So once we submit an offer on a home, typically that home is going to be contingent on your home inspection, the financing of your loan, as well as the appraisal. And once all those contingencies are met, that just gets us a step closer to the closing table. Congratulations, you are now a homeowner. That dream home that you have worked so hard for is now your home. Congratulations. All right, so now we want to talk a little bit about title with Joey Van Daniker with Universal Title. Joey?
Carole, thanks so much. And yes, really great to be here. Appreciate you and Aaron inviting me on. And sure thing. So for title companies, I do believe our work is a lot of back office work. And for that reason, I think what we do is a little elusive to the average home buyer and home seller. And that's okay. What we do is really create good relationships with Carole, Aaron, other industry folks, and just make sure that we're doing what we should be doing. And I'll explain a little bit about what that is. So a title company, three main functions. Okay, we hold money, we work closely with all the parties in the transaction, and then we review the chain of possession of the property, and I'll talk more about that in a few minutes. So as far as holding the money, we are an escrow company, right? Some jurisdictions actually don't even refer to it as a title company, they say it's the escrow company. Escrow just means that we have funds that are held in our trust account that are meant for a certain purpose. So in these cases, we're going to be paying the seller after the transaction closes. We're going to be paying the county or the city of Baltimore or the city of Washington and the state of Maryland, right? And there's also going to be vendors in the transaction that are going to be getting paid as part of settlement, right? So we're a neutral third party. We work closely with everyone, as I mentioned, but we're holding those funds and we're going to disperse them after closing. So as I mentioned, we're working with everybody here. We work really closely with Aaron and the lending team. We want to make sure that buyers' dollars and cents are all accounted for and that we have everything nailed down to the exact penny by the time we close, right? We're also working with the seller side of the transaction, the listing side. We want to make sure we're paying off the proper mortgage, right? Not somebody else's mortgage, but this seller's mortgage. We want to make sure that we are addressing any other liens or encumbrances that exist against the property. For instance, a lot of homes are located within a homeowners association. So we're going to collect whatever dues are owed for that next month. If there's a balance on the account, we're going to make sure we collect that from the seller the day of settlement, right? There's some other places, like if you're in Howard County in Columbia, there's the Columbia Association. And so we're making sure that we have all the taxes for the county, for the whatever jurisdiction that property is located in. We're making sure we're square there. And we're working with everybody to get those numbers straight. And as I mentioned, we review the chain of possession of the property. In Maryland, it's customary to go back 60 years. And we're making sure that everybody who's owned that property in the past had the legal right to sell to the buyer. And we're making sure that this seller has the legal right to sell to this buyer, right? So we want to address any encumbrance that may exist against the property. I mentioned the HOA, but there might be some other third-party creditor lien that the seller has created, maybe Capital One, or there's income taxes that haven't been paid or something like that. And we're calling that out and we're addressing it. And as far as all of that goes, we then provide title insurance. Let's be honest, if there's a human touching it, there's room for error. So it's possible that something may have been missed in our title search, misindexed in the land records, or missed by one of our attorneys. And then we have this title insurance. There's two types. There's the lender's policy and the owner's policy. Lender's policy, it's just part of getting a mortgage. The lender's loan is protected by the lender's title insurance policy. It does not protect the owners at all. The owner's title insurance policy, although optional, is purchased in most all transactions, and it protects the owner for the lifetime of the home, and if left to heirs, against any liens, encumbrances that are covered that didn't come up in our title search or was missed by one of our attorneys. It also protects against somebody claiming a physical interest in the property, right? Somebody saying that, hey, this home should have conveyed to me in my deceased aunt's will, and now I want it, right? And it also covers the litigation for those matters. So in a nutshell, that is what a title company does. As far as universal title goes, we have multiple offices in the DMV. We can still process out of my office and close in any one of those venues, and we really just try to make it the best customer client experience that we can. And thankfully, we've been around since 1979, so we've stood the test of time. And we really just try to be a partner with those with whom we're working, like Carole and Aaron, and it makes everything go really well.
Okay, so we just had a couple questions come through for Joey in regards to title. The question is, who holds the earnest money deposit, and what happens if there is a dispute?
Yeah, great questions. Thank you, Carole. So in most cases, the title company is holding the earnest money deposit. There's still, every now and again, a brokerage, a real estate brokerage that's holding the earnest money, but generally we hold it. And I think it's kind of a better way where, again, a neutral third party, as I mentioned earlier. And as far as a dispute goes, well, generally what we're doing is waiting for an agreement between the buyers and the sellers. And if there's certain things in place with regard to how the termination has occurred, right? That's usually what's taking place, is that there's been a termination of the contract of sale, and now the buyer wants the money back, or the seller says, well, I've had this property on the market for the last month, now I need some of that money to make me whole again. Well, I usually allow the agents and the buyers and sellers themselves to sort of come to an agreement. And what my experience is that reasonable people tend to come to agree, right? And if for whatever reason it has gone beyond that, there is some contract terms that require those parties to go to mediation, and then ultimately they can take it further. But I generally don't see it go that way. Usually we receive an agreement that says, here's how the money's to be dispersed. X amount goes to the buyer, X amount to the seller, all of it goes to the buyer. And rarely have I seen it all go to the seller, but sometimes that happens too.
All right. Thank you, Joey. We have a couple other questions. Aaron?
Yes. So my questions, Joey, I know, we have some Q&As coming in. As a lender, some of the things that I come across that can come up is, what if a property has solar panels?
That is a great
because
question.
it's a deed title situation.
Sure thing. Yes, so we do have to address it. And my experience is that, finally, the contract drafters, for the different associations have woken up to this issue, because it is so common now for panels to be on a property, is that it's a contract term that the buyer is agreeing to assume this agreement. And usually the lease agreement is what we're after. We want to make sure that we've read it, and buyer has read it, and the buyer has agreed. And I think this, to your question, Aaron, it does affect what a buyer may owe as far as debt to income on a monthly basis. Now, from what I hear, solar panels are usually for the benefit of the homeowner, but I'm not quite sure how all that works. But once we know that there's solar panels on the home, we certainly want to see that assumption agreement signed by both the seller and the buyer.
Okay.
Thank you. So what I run across with the solar panels is no one ever tells the lender. So if there is a payment of $65 per month, what could happen is you may not qualify for the loan. So it's really important us as a lender that we know that right up front in case we're going to run into qualifying issues. So that is really important that it is told to us up front.
Sure thing.
So Joey, one of the questions that I have for you is regarding property taxes. So when we see a listing, there's taxes that are listed in the listing. However, when you start to do your research, the property taxes may not be the same amount that we see when the property is listed. Can you tell me why that is?
Sure thing. Great question. And yes, we do run into that. For whatever reason, sometimes what's in the multiple listing service or even online may not reflect exactly what the taxes are, and certainly not for the next buyer. One of the main reasons is that the current seller, the homeowner, has an exemption of some sort. In Maryland, for instance, there's certain jurisdictions that allow for a homestead tax credit, right? For certain homeowners that are above a certain age, right? There may be Maryland has 100% exemption for military veterans suffering from an injury, a service-related injury that's made them 100% disabled and or have that 100% rating, and it's a full exemption. So we have to make sure that we're telling the loan department that the money that's currently being collected for this property is not going to apply to this new buyer, because it's going to be more, because this exemption is not just going to immediately transfer with the deed on the day of settlement. And Aaron, that does bring up a couple of other things that I think is really important for borrowers to know, as I'm sure you're aware, for the debt to income, because when we are doing our title search, we sometimes identify things that the seller should really be disclosing in the contract of sale, but for whatever reason has not. One of those things is called front foot benefit. And the more official name would be deferred water and sewer charges. And usually they range from between $250 to $1,000 per year. And front foot benefit or deferred water and sewer charges is when a developer goes into an area, subdivides it. The county will charge that developer money to hook up the county pipes to each individual dwelling, to each individual home. And then the developer charges the subsequent homeowners for a period of time, usually 33 years, to get that money back. And then some, right? They get a little bit more. So that's something that we identify, and that might throw off the borrower's debt to income. Same thing, if I mentioned front foot benefit, there's also what's called leasehold or ground rent, and it's kind of an antiquated thing. We don't see new ones, but what we do see are these old contracts, usually in Baltimore City, from the early 1900s, even some in the late 1800s, where somebody has a very low ground rent on the property, low amount, meaning like $120 a year, and they own the ground beneath the improvements. And that $120 a year may throw off the debt to income for that borrower. And for all intents and purposes, the borrower is going to own the home in a leasehold or a ground rent situation. But there is this other interest that has to be accounted for. And that's something that we do run into in our title searches. And we're letting everybody know once we've found those.
Joey, that is great information. Can you tell me, for the leasehold and for the front foot benefit and even the solar panels, are those things that the buyer can, especially if we have a qualifying situation, could they buy those things out? So let's say if they owe just $1,000 left on something, like the front foot or the solar panel, can they actually buy that out?
Yes, so we'd have to discuss that with the front foot benefit company, right? A lot of them do allow for a buyout, yes. And sometimes we do run into the situation where there's only 1 or 2 years left on that property. So that is a discussion, and many times the answer is yes. I can't say blank, like a full 100% yes, because some front foot benefit company may say, no, that's not something that we agree on. And they do have a lien against the property, and it is for a certain amount of time. So we kind of handle it on a case-by-case basis. As far as the leasehold goes, so there is a statutory process that is allowed for what's called redeeming the ground rent and allowing the homeowner to become what's called the fee simple owner, and that's the best type of ownership to have, as opposed to leasehold or owning a ground rent property. And yes, they can be redeemed. Usually, it might amount to a couple of $1,000s, and we have to contact that ground rent holder and have that party execute that deed as part of the settlement. But yeah, it happens frequently enough.
Thank you.
And we do have one last question that is coming in for title, and that is, as a buyer, do I have to have title insurance?
Yeah, great question. So I'd certainly recommend it, yes. However, the owner's title insurance policy, definitely optional. It is purchased in most all transactions, and it doesn't operate like a homeowner's insurance policy would that's recurring. I mean, you purchase a owner's title insurance policy, it's usually about 0.3% of the purchase price, so 1/3 of 1%, and you own it for the lifetime of the home. right? So it is optional, and sometimes folks say, I'm just going to go ahead and move forward, and hey, that's up to the home buyer. But as I mentioned, I feel like it's a no-brainer.
Okay.
But, yeah.
All right. Well, thank you, Joey. And that wraps up the Q&A for the title part of this seminar. So thank you again, Joey.
Thank you. Thanks for allowing me to participate. Great being here.
Absolutely. So one of the questions that we have is actually for me, the realtor, is can I go to an open house without having my realtor present? So the answer is yes, you can go to an open house without having your agent present, but the best thing is to have that conversation with the agent so that your agent who represents you can actually reach out to the agent that's actually on duty for that open house and let them know that you are actually going to be there and you do have representation.
All right, the next question we have is, what is the earnest money deposit and when must that be submitted? Carole?
Okay, so as you mentioned, the EMD is the earnest money deposit. So that deposit actually goes along when you make an offer on a home. So that is the good faith amount that you're actually putting down when you're making that offer. So that money is actually collected or deposited typically either with the brokerage or the title company like Universal Title, and the contract actually states exactly when that money will be deposited. Sometimes if the agent actually physically has a check right then and there, then they would say that they are in receipt of that deposit, or it will be due within 3 to 4 business days, typically is how I write the contract, once that contract is actually ratified. So this question that is coming in is actually for you, Aaron. The question is, when can I purchase a property after a bankruptcy or a foreclosure?
That's a great question. I'm glad they asked that question. So if you filed bankruptcy for an FHA loan, it needs to be 2 years after the discharge date before you can purchase using FHA financing. If it's conventional, it's 4 years. And then for the foreclosure for FHA is 3 years, and for the conventional, it's 3 years. So the big thing is, just because the bankruptcy and the foreclosure has been discharged does not automatically qualify you for a loan. You have to show that you've reestablished good credit payment history on the credit report as well.
So one question I have, Aaron, is what is the benefit of using a local lender over one of these big box lenders or internet lenders?
That is a great question. I wish more people would ask that question to me. So one of the benefits, especially when you are trying to purchase a home, is making sure you have access to your loan officer. Mm-hmm. When you walk into your bank, what are their hours? Monday through Friday, 9 to 5. When you are using an internet lender, yes, they could be in a different time zone, but they may not always be working. So the time that you really need them to discuss your pre-approval, you might be passed on to someone else. The benefit of working with a local lender is you have access to them when you are physically out there looking at homes and putting offers. I'm available. We can run numbers, estimates, and pre-approval letters. It's very important that the selling side knows that there's a lender on the other side that they can reach to make sure the settlement date is met. And if any additional questions are needed, that they have someone that they could talk to outside of normal business hours.
Thank you guys for tuning in to your guide to homeownership. I look forward to seeing you at the next showing. If you have any additional questions, please feel free to reach out.
And this is Erin, and I look forward to helping you find the right loan program and the loan type to get you into your first home.
And thank you again for watching, everyone. I hope to see you at the closing table. That's the last thing the title company does, is get all the documents signed to send you on to your new home. Thanks again.
Thank you.